Meeting in here? Huh? All right. Let's do it then. Why is that doing that? I guess this joke didn't go as well as I wanted it to. There we go. Jeez. That didn't work. I wanted to walk in. Big on Wall Street this day. All right, let's do some predictions. We're going to do some predictions on PayPal, on SoFi. Stock is up quite a bit today, ladies and gentlemen. So that'll be quite nice. Happy Halloween. And we're going to look at some of my colleagues on Wall Street, what they're up to. See what they're doing. Let me go ahead and take a look. I don't know why everyone on Wall Street's Italian, but this just recently came out. All right. This is analyst expectations for SoFi as of today. So what we're seeing is KBW, BTIG, Wedbush, $3. $3. Bank of America, Mayer, Jeffrey, and Andrew. Andrew actually lowering his price target from 16 down to 14. Jeez. Okay, so, ladies and gentlemen, what do we think? I mean, they are not seeming to like any of the news that SoFi is giving out in terms of member growth, in terms of anything. They are mainly just focused on if we're going to get capital constrained and if we're going to give up a lot of those growth rates, because Noto might have warned us that lending might be slowing down the overall thing. Sorry, I'm all messed up now because that intro, I wanted it to be funny and it just ended up echoing. Whatever. Okay, ladies and gentlemen, on the other hand, SoFi stock is up 8.8% today, giving back some of the gains that it gave up yesterday, bringing it all back. Just a delayed reaction to the overall stock good performance of the company. This could have been a little bit due to analyst predictions. However, who does know these days? That being said, I wanted to go over mainly PayPal today, as tomorrow is their earnings results. And even today, Paycom actually came out showing off some pretty terrible guidance, leading the stock to essentially a bad result. Okay, so very not good, unfortunate, and maybe scaring away some of the fintech investors, even away from PayPal. Now, I want to go over what PayPal investors have said recently, or not investors, sorry, executives. Let me go ahead and show you guys what they've said previously, because they've indicated a couple times about what we are to expect for Q3. One of the things, just while I'm bringing up this thing, is that they actually received merchant cleanup fees, which they benefited from last year of about $190 million. They saw about $75.5 million in each of Q2 and Q3. Now, to be fair, we are not going to be seeing this year. And so whenever we're talking about year-over-year growth rates, those have to be factored in, that there was a one-time bonus to us last year, and that is going to negatively affect growth rates. They did say, however, they still do expect, quote unquote, Dan Schulman himself, we expect to grow revenue by approximately 8% on both a spot and currency neutral basis to approximately $7.4 billion at current spot rates. In addition, we expect non-GAAP earnings per share to be in the range of $1.22 to $1.24, representing growth of approximately 13.5% at that in the midpoint of the range. That being said, let me go ahead and bring up a couple things. So this is actually software that I use called Koifin. Just looking at the percentile ranks, okay? And now it bases it against other financials, which I don't think is necessarily fair. It is a financial company, of course, but they're ranking it against a lot of banks with maybe potentially lower margins. where I find PayPal should fall more under the tech category. Definitely more, techie than a lot of the banks. However, falling for sure. Whenever versing it on its own company's 10-year history, potentially, maybe I can even blow this up. So this is on a percentile basis. The price to earnings ratio, okay, for the next 12 months is at a 0 percentile over the next 10 years, okay? Meaning this has never been this cheap before. In the last 12 months, never been this cheap on a price to sales basis, on a price to book basis, not on a price to tangible book. From free cash flow, it's a 2. Price to gross profits, all 0, 0, 0, 0, 0, 0, 0. The stock has never been this cheap. On valuation yields, cash flow to enterprise value, it's a 98 percentile. Buyback yield, it's 100 percentile. It's never been this high. So whenever you start to factor in these things, looking at this stock this way, you'll realize that we are in incredible times. This company better be dying soon to actually price in some of these valuations, right? What I'm also able to do on this software as well, and hopefully you guys check this out. If there's one thing I can ask of you, it's just click on the link down below and see what they have to offer you. Because honestly, I try to tell you guys sometimes about the offering that Koifin uses. I use this every single day now, okay? Every single day. I really have no need to use anything else. Going through this thing, there's so many tools. Click on that link. They'll even give you a free trial if you want to try it out. Even if you don't, just go there to read some of their offerings because it's not even covered here. But let me go back. I was going through some of their transcripts. So this is every single transcript that they've ever done. You can go all the way back in history, okay? One of the things that you can do is just search these transcripts. And then we can just search in like, when's the last time they mentioned third quarter? And then it'll be like, okay, well, they actually mentioned it in their last earnings call. And we can go there and then go and click to what they said during those times. So it's amazing for due diligence whenever you're looking at what did people actually say during these times, right? This is exactly where I got this piece. For the third quarter, we expect revenue to grow at approximately 8% on both a spot and currency neutral basis to approximately $7.4 billion at current spot rates. And that was said by, let me see here. Oh, that was actually said by Gabriel Rabinovich. Or Gabrielle, sorry, CFO. That being said as well, just while we're looking at that, that's how I do a lot of my due diligence. But Gabrielle also did say in one of these earnings calls as well, she said, we expect to exit the year in a much stronger position from a transactional margins trajectory than where we are right now. She said that in Q1 of 2023. However, they did say this is not supposed to be happening in Q3. This is the real expansion and betterment for transaction margins, which is the big key factor that people are going to be paying attention to, is actually going to be in Q4. Okay, they said Q3, there's actually not going to be, this is word for word, her exact wording once again. She said, I think it's worth saying that I'd expect to see some pressure on operating margin with some maybe some more slight pressure in Q3 than what we saw than what we will see in Q4. We will see expansion then once again. So my expectations is transaction margin is still going to go down. They've been pretty clear about that. Okay, so I'm not saying that this is the end all be all quarter for PayPal. What is exciting, hopefully, is that a lot of that already, compression is already priced in. I think that's what people are really beating down the stock, is because we're still going to have to wait a little bit. And then maybe there's also expectation that they might not get it back in Q4. That's why I think that guidance is the most important thing of this quarter. Transactional margins and guidance. Guidance will tell us, especially hearing it out of Alex Chris's mouth, what do we have in store for PayPal? Be honest with us. Is transaction margins going to continue to fall off a cliff? Okay. And another thing, because everyone's looking at all these payment providers all around the world, and they're going, man, they're getting crushed. Their guidance is getting destroyed. They're losing clients. Well, those companies are not going back to cash. Someone must be winning these clients. Okay. So Stripe has made it known that, Braintree is making larger deals. Okay, Adyen has made it known that Braintree is in the stages for bigger deals and potentially even probably doing it at a loss. Okay, one thing that I find is crazy is that PayPal has another part of their business to make money. PayPal Wallet is where they can actually make a lot of their money, and then they can actually, get the clients through the door with Braintree, end up paying the loss there, and then end up winning them over whenever they use PayPal checkout to actually make that purchase. Kind of owning both sides of the transaction. Tanner going to no, I'm dressed up as a Wall Street analyst. This is my Halloween costume. Just happens to also be my actual office costume, but I was trying to do a Wall Street bit at the beginning. I had to start the live stream with my phone, and then it was echoing, and that was a disaster. But whatever, we do it from time to time. That being said, what else are people saying in the comments? Corporate Tanner, yeah. Oof. Yeah, I thought I'd pick a little orange because the orange is for Halloween. We had a lot of kids today. My first time actually delivering some treats. I mean, I'm in my own home now. It's beautiful. Beautiful. That being said, let's get back to it. So, one of the things I also saw this was crazy. Let's step off PayPal for a sec. We will be back later. Jason Mikula, hopefully I'm saying that right, posted this screenshot, which is quite scary, and said, "Not sure who's running direct mail strategy at SoFi, but you may need to tweak your response model." Sorry if I didn't correct myself there. Look at this, guys. SoFi. Who knows how long he's been collecting these for, but geez, that is a lot. I feel like this is how they do it for my email box. I'm not even in America, and they're like, "You're pre-approved for a credit card, you're pre-approved for a personal loan, you can get a home loan if you like, just get over here." And all I did was sign up for an account. But hey, you cannot bash success. So it looks overwhelming. But hey, maybe they're spending too much money on postage. Maybe they would be a little bit more profitable. They stopped sending Jason so much freaking mail. But yeah, I think he's in investment banking or something, or Morgan Stanley. Jason is. So, potentially that's the target audience that they're looking for. Okay. Did we want to see? Oh, someone mentioned as well that whenever I was speaking about Kathy Wood yesterday buying $3.3 million worth of SoFi stock after this weird movement in the stock. Obviously, she's seen some good return on this. Obviously, it just turned around over 8% today. How much of a change does this make in her overall portfolio? Well, she now owns $8.7 million in the stock total. So that means, before this, she actually owned 5.4 million. Now it's 8.7 million. Quite a large purchase, considering the size of her overall portfolio. Very, very interesting. However, people also wanted a little bit more clarity on this BlackRock deal as well. SoFi and BlackRock getting into bed together. What's all this about? Because obviously $375 million is a good price tag, but I think they were happy to say who the partner was because it could obviously mean a heck of a lot more business. So there are some interesting things here, and why don't I just turn that to dark mode really quick, killing my eyes. I just want to read some of these quotes. So this one's from Anthony Noto. He said, "Our access to different sources of capital is a critical component to growing our lending capabilities and better serving our members. BlackRock's great collaboration, seamless execution, and ability to invest across the entire capital structure made them an exceptional partner. To date, SoFi has sold over $14.5 billion and securitized over $13.7 billion of personal loan collateral. The transaction issuer will be SoFi Personal Loan Trust 2023, backed by a pool of SoFi personal loan collateral, and the transaction is expected to settle by mid-November. Here's a great quote from Vice Chairman at BlackRock. They said SoFi has built a strong platform by focusing on its members and continually innovating to meet their needs. We are excited to help them grow their lending business while at the same time accessing differentiated investment opportunities, which is an important part of the value proposition for our clients. Advisor and initial purchaser to this transaction is Citi. Quite interesting, quite exciting. Very, very happy to have BlackRock as a buyer of our loans, because obviously if they do well and they perform better than others, there will be an endless supply for them. If you're talking about someone who has a ton to have committed capital for, obviously that is quite exciting. Frank bought it? Frank bought what? Frank bought what? I want to know. I was going to get the little soundboard, the, hey, it's Franklin. I was going to get that where whenever Franklin comes into the chat, I can just press the soundboard, and I'll probably do that. So hopefully he's not here. That way we can surprise him next time he's here. To the people who don't know who Franklin is, he's an angry little man that likes to come in here and talk bad about any stock that is covered, regardless of if he's a champion of the stock or not. He'll sell his position if I talk about it, and that's fine. Okay, do we want to watch a little Anthony Noto on CNBC? I think I do. I wanted to bring this up as well, mainly because it shows great insight into how people see and talk about SoFi. One of the things that you'll see be brought up here as well is things like, oh, well, I guess, student loans are back, so you guys are, very excited about that, and now your business can start to grow. And Anthony Noto will kind of correct them, talking about how that's a very small part of our business at this point, but still, it goes to the mindset for how people actually think and talk about SoFi stock, is that it's still just a student loan lender.
Let's get to SoFi CEO Anthony Noto joining us in a...
Can you guys hear that, by the way?
First on CNBC, always good to see you. Student loans, at least the analysts seem to be a bit short here in terms of what they anticipated. It may have come in, I think on the call, you sort of seemed to indicate you expected that that surge, but tell us a bit about that and what you're seeing there, whether it's the cadence, is it a one-time thing, Anthony, and it gets back to normal, or is there going to be significant demand for these loans for some time?
Yeah, so David, I think there's just a misperception that student loans were a big driver in the quarter. They were not. 67% of our absolute growth in revenue dollars was from non-lending, so our technology platform business, as well as our financial services business, which includes checking and savings, investing, credit card. We did see a recovery in the student loan business from about $400 million of origination volume to $900 million of origination volume, but it wasn't that big of an impact on the overall P&L, just given how those values are.
Wasn't that big of an impact, which is true. I mean, look, we signed $3.8 billion of personal loans alone. Let alone, like he said, 67% of the growth came from non-lending. What's $900 million from student loans? It's exciting. Okay. And that's not even 900 million. I mean, we were doing 400 million every single quarter before that anyway. Incremental, it is still a jump, but it's very small in terms of our overall originations. It's very, very important to understand that.
Those loans are valued. So the bigger driver of it was the really strong performance from tech platform and financial services, and still continued strong demand for personal loans. On the student loan side, to answer your question specifically, we think it will be a slow, steady, gradual increase over time, and that we're not going to get back to where we were in the fourth quarter of 2019, which was about $2.4 billion origination volume a quarter for some time period, probably not until 2025.
Got it. Well, on the call as well, you seem to try to focus the analysts on the technology platform. Explain to our viewers what you're talking about here, Anthony, when you say the...
No, that's a basic question. I'm going to move on from that, but I did want to just close on that whole idea that, like, still, even CNBC, even after being on for so many times, is still fixated on these basic questions. Robert in the chat says Bloomberg video was much better questions. I have that here as well. I don't know if we want to hear that, but if you guys want to listen to it, I can pull it. I mean, it's literally on my screen right now. But I don't want to just keep playing videos. So let me know if you guys are interested in hearing that out. But I also did want to bring up this as well. So this is a topic that I think I was on the phone literally speaking with Stephen Fiorillo about this yesterday. It's so important to me that people understand this, because it's just a part in investing that I don't think people fully understand. So one of the things that I find important is whenever a stock posts earnings, okay, and I mean on a day-to-day basis, a company is making real revenue, real profits, depending on the company, right? But over time, the company is making money. But only every 3 months is it actually public, okay? During those times, it's super important to look at multiples, because usually what should happen is a company like SoFi, in SoFi's position, if, for example, they're not given the love in their stock price, whenever there is actual real gains that are being made, if people still want to hold up the same expectations on multiples that they were before, let's say SoFi previously has seen a 1 times price to book ratio, right? It's sad but true. So if at minimum they hold up a 1 times price to book ratio, if they then year over year grow their tangible book value by $171 million, then the stock will have to reflect that just in order to keep that one single metric, let alone if everything else doesn't grow or whatever, right? So if the stock price doesn't change, but the actual fundamentals do, that means multiples are coming down. So you don't necessarily need a cheaper stock price in order to see a cheaper stock. Does that make sense? So to show off what I'm talking about here, I wanted to just bring up this this. It's actually on Koifin as well. Sorry, everything is going to be Koifin from now on because they offer everything. Okay. I was just looking at some of the multiples on their financial analysis for SoFi, which, to be fair, they're not profitable yet, so they're not tracking some of these earnings. Whenever we look at like a PayPal, for example, there's a million metrics that we can look at over a 10-year history. This is really only for a couple, quarters since they've actually been public. Right. So if you look at the price to sales on SoFi back in the day, 17.4 times, 19 times, on a forward basis, 11.4, 12.4, regardless, right? Then, as we start to get into later and later quarters, last quarter, whenever it actually hit the most recent quarter, we had a 6 times price to sales ratio, a 2.1 times price to book. Last quarter before that was 1 times. Okay. So although the stock price hasn't even changed, but we've brought down a lot of, the stock price did change between Q2 whenever they reported to Q3. I think the thing is the difference between what it was yesterday, assuming that multiples were at 6 times, to today, when we're assuming now price to sales is at 3.5, it is a much cheaper stock. The price to book, if we were looking from last quarter, was 2.1 times. Today, it's 1.3 times. Although the stock price hasn't really changed all that much. Today, it's now starting to reflect that, actually being up 8%. A couple of these factors had to happen, right? So Google Finance, for example, and there was another one. They were just simply reporting wrong numbers on SoFi. Now, how they actually source their numbers, I'm not sure, okay? But like in no tangible way was Google Finance accurate in the numbers that they were actually portraying for SoFi. And today, if you look now, it's actually changed, okay? But still, it's very important, because if there are algorithms and there are these systems that actually trade on SoFi just based on normal metrics that come in, then things like GAAP net income being down like 220 million this quarter is going to make a big difference on the stock price, even though whenever you actually look on it, it's a goodwill write down because of probably a company that we had overpaid for. I'm assuming it's Technisys. Richie Mello, thanks for the $2, my friend. Tanner looking like Review Bruh with that suit. I don't know who that is, but appreciate it. Yeah, no, I put a ton of, I didn't put gel or anything. I just put water in my hair, but I'm trying to just weigh it down. I thought I looked like I'm out here on Wall Street. And hey, I might do it more often. I mean, I like being in a suit. That being said, let me drop off of this. That is Koifin. What else actually happened? I got a couple things. We did the SoFi marketing. That was quite interesting. Yeah, Paycom got absolutely crushed. I think that in order for PayPal to have a good quarter tomorrow, like I said, I'm gonna just go over this one more time. One, transactional margins are going to be a big talk of the town. However, they've already spoke how there is going to be large pressures. They've been saying that since Q1. Okay. Next, it will be mainly on guidance. Q4 is the big quarter. That's what it's all going to depend on. If transactional margins are going to have that turnaround that they've been saying for quarters now. And then probably the third most important part is, where does Alex Chris come into this play, right? I'm hoping this is a little bit extra of a long call to sort of see his vision, to see what he's talking about, and get a little bit more insight onto how he sees this stock and where do we go from here. And then next, all these companies that are losing large clients, is Braintree actually the company that is picking all of this up, right? Because if all these public companies are losing, we don't get to see Stripe's numbers and we don't get to see some of this stuff. So we only get to see interviews from time to time. Is it actually due to Braintree? Because if they're coming in lowest on the, lowest cost across the board with still very good features, good enough, maybe not as good as Stripe or Adyen, I'll give it that. But if you're cheap enough, people will absolutely integrate with your software. And especially if it's going for more of a, price, price over benefits right now, or price over features. What are you expecting from your boy, Alex Chris? A vision. Are we breaking into Europe? Is that the big sort of feat that we're going after? Are we just getting our feet in and there's still so much work to do? Are we realizing that there's a ton of bloat? PayPal has a ton of employees, right? And we've already cut a lot of our expenses, and there's only so much that we can do with that. But there also might be massive, like what Elon Musk did to Twitter. Like, is there a 30% bloat in this company? And we've only been trimming because some of management has been focused on hiring as their bonus metrics. And so because that used to actually be the case in like 2020 and 2021. A lot of these companies, these management pay structures would be based on how many people that they were actually managing. Okay. You manage a massive team, then you actually get paid a lot more. So they were incentivized to hire. And so whenever you're incentivized to hire, you get bloated. Okay. If you get incentivized, like if Alex Chris just comes in and say, hey, this is done. And I'm not saying that that's what PayPal is doing, but if they were, and they need a big switch, Alex Chris has a lot of opportunity to make big change. I want to see how a young buck like Alex Chris can come on the field and mix it up here. That'll be very, very interesting. I'm very interested to hear Alex Chris, and hopefully institutional investors like what they hear. Well, I mean, hey, me too. Me too. Tanner, would you explain what the $2 billion forward flow agreement means? Thank you. Doug. So Doug's talking about SoFi, the $2 billion of committed capital for SoFi, meaning that a bunch of these companies, and I think they said it's mainly one large partner that's actually bought from us previously that is now going to buy from us again. They like our product. They like the way the members are being serviced, and the default rates are either within standard or below, right? If there's repeat customer, they like what they bought. Okay. They're saying, hey, because you're doing so well, there's $2 billion more for you whenever you find new books for us going forward. So it's just essentially saying that we can grow our book for additional $2 billion to sell loans, and we already have a customer ready to go, right? It's like whenever Elon Musk said, NVIDIA can't make enough chips for us, the second they offer it to us, we're a buyer. Okay. So essentially that. It's just $2 billion of committed capital saying, hey, this is for SoFi. That's what the banks are saying. Now, who knows who that client actually is, which company it is? Maybe it's Citigroup. Citigroup's already a part of these transactions with BlackRock and SoFi, and there seems to be a growing relationship there. And not to sort of give a little insider information here, but like if you guys look at what Bender 9000 is posting, you'll see that Citigroup and Technisys have a relationship. You'll see that like the tech platform Citigroup is a part of, and there's all sorts of different relationships with these big banks that SoFi is creating over time. As we start getting into these syndicates with them on the IPO side, we are going to be absolutely ingrained in the financial institution or financial sector of America, and just continue to make a ton of money. SoFi will, in my opinion. Shift4 said they only get scraps in Vegas because Braintree is basically signing folks charging nothing. Well, they are. They're practically taking a loss on it. Like, it's funny. They charge less than what Adyen's charging, and yet they have to find partners for a lot of the work that they're actually doing, where Adyen can just offer everything all built on their own stack, and they still can't offer as low of rates as Braintree, because that's not where PayPal's making their money. It is on branded checkout. And if we remember correctly, let me show you guys a couple things. Let me bring up my spreadsheets here. And I'll show you a little bit of extra insights into what PayPal, Venmo, SoFi have been up to, these sorts of companies. So and if you guys like what you're seeing, a lot of this information is sourced directly. Whenever it's website traffic, it's SimilarWeb. Whenever it's actual company information, it's always their 10Q or something like that. If it's quick information or transcripts or multiples or valuations or anything like that, it's all Koifin. And that's my one ask from you guys today. Just click that link to Koifin and see what they have to offer. Because if you guys are a serious investor, I feel like it's literally the Bloomberg terminal for retail investors. Here we go. So I'll be able to update this very, very shortly. If you guys don't know, it's Halloween, October 31st. So in a couple of days, we're going to get, that next month. So we'll have that, and I'll fill that out for you. But for now, what we could see is SoFi over the last 3 months had done very well, and then crapped the bed in terms of SimilarWeb on the last month. So it saw a big drawdown. We saw that in Robinhood as well. However, not doing as great for every quarter before that, but a big drawdown in the last month. Big drawdown in Ally, big drawdown in Upstart, big drawdown in Lending Club, Nubank, Venmo, not in Cash App. This is the only one that really surprised me. They were going down, 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 and then massive spike up. Okay. So I don't know if this is a change to their algorithm or something, that every single fintech across the board in September had gone down aside from Cash App. But one thing before, if we just exclude this just for one quick second, okay? I'll return it. Don't worry. I'm not trying to ignore data here. But across the board for PayPal, it was up, 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 up. Venmo was up, 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 up. Just in the last month of Q3, did we actually see drawdowns? Okay, so I do expect PayPal, which whenever going into July, even Dan Schulman himself said, we are seeing great numbers in branded checkout. I think they saw 9% growth. They're on target for 9% growth in July. Hopefully that continues and we do see good things. But kind of good to have that extra little bit of information. So, what else? Any other questions or concerns? Why is there so much talk of capital constraints if these deals are in place? Robert, 100%. One thing is that will we be able to get the exact amount of 105% or even positive numbers on that committed capital. They can be buying below fair value. That means that we made a bad deal. Excuse me. Next, $2 billion of committed capital, an additional $375 million from BlackRock potentially. All these funding, that is good. Okay. We did about $5 billion in SoFi originations, and that's without growth next quarter. So next quarter shouldn't be 5 billion again. It should be 6 billion or something along these lines, right? It should be more than what we already saw. And so if we're committing $2 billion going forward and we're signing up 6, that math does not compute. Okay. So yeah, it still is a problem. We are still growing much faster than people are buying. If, for example, rates are completely stopped, then it could actually mean great things for SoFi's loans. The ones that we're signing up now, okay, could actually be sold for a high amount because potentially those what do you call it? The coupon rates that we're actually receiving, the percentages, the APRs on those actual loans will be extremely high. Okay. Older books that we've been holding on to that maybe we signed while rates were going up might be at lower coupon rates. And so those ones might not be as exciting for a potential buyer. And so we might have to just hold on to those, which means maybe slower growth for us going forward. I don't understand the amount of stock-based compensation from PayPal whilst also buying stock back. Why not use the cash flows to support some of that stock-based compensation expense? What do you mean? Like just give them cash bonuses instead of stock-based compensation? Could be original deals that they signed with their with their company whenever they originally signed up. I'm not sure. But the whole, like, either you use your cash flows to give them cash bonuses, or you take that cash and buy back stock and then negate the stock-based compensation. It's the same thing. It's the same thing. You either put maybe we take 20% of stock-based compensation off their hands, or we return 20% back to the stock in terms of buybacks. I don't know, unless I'm not thinking correctly, that would be the same math. TJ, what's up, my friend? Good to see you. How was Vegas? Doug, that was super cool. They did actually say that it was very exciting for them that the IPO access actually did lead to member base growth, which is really exciting. In terms of the overall monetization from IPOs, the problem is that there are some of these cap tables, there will be leaders for these syndications for how many different banks or partners that they need to bring on to bring these companies to IPO. And so what happens is these big syndications of multiple banks. I think for Instacart, it was led by Morgan Stanley and JP Morgan. I'm pretty sure, if I remember correctly. They led this syndication, which means they have the highest amount of exposure or risk to that company. And the risk was that they bought all the stock directly from Instacart before actually selling it to the public. Okay. And so SoFi's role was a small part of that pie where we bought and held that risk of Instacart. What we were able to do was then turn around and then offer it directly to our members for that very same or maybe small increase in that percent that we actually got. Better than what they would actually give out to the general public. So I'm sure we were a very small fish on that table, is all I'm trying to say. I actually think it was Throwable that was asking in one of these chats if how much could the IPO access actually lead in terms of monetization. We would be such a small company whenever it came to parts of those IPOs. It's not like we led the IPO. We were a part of it in a very, very small slice of that pie, just because of how much capital and exposure that we could actually comfortably take on. ETF, you didn't hear? I mean, hey, I'm a Wall Street analyst this Halloween, okay? This is what I went trick-or-treating out in. Went to go visit all my neighbors and stole all their candy. Couple Twin Peaks, huh? All right. Tax issues. Company pay tax for employees. Not sure. I'm not sure how that would dig into stock-based compensation versus a non-issue or versus cash. JP Tanner instead of Morgan. Is that what you're going for? I guess more misleading than anything is to tout $2 billion in stock buybacks whilst issuing $1.2 billion in stock-based compensation. I don't know. I don't think that it's quite that easy to look at it like that. If you just look at the outstanding shares over time, they're falling off a cliff. I think overall their stock-based compensation is large for the size of the actual incumbent or due to the competitors that they're actually with, but I don't think that it's that crazy, to be honest. So smoldering, you blurred the camera. No, it's my camera. I have it on manual focus, so I can bring it forward, and so it's really only set for exactly where I am right now. If I just lean back, I lose it. I absolutely lose it, but that makes it crisp whenever I get it right. So, handing out SoFi analysts to trick-or-treaters. Recommendation link to your parents' little Jimmy. Yeah, it was a little price targets on every single one of the things I wrote on the back of the candy bars. And price targets, even you guys don't hear about. No. Ladies and gentlemen, that's it. SoFi up 8.8%. Where's all the bears today? You know, they're all gone. They all wanted to talk crap on the Twitter the other day, but not today. They were quiet. Are you dressed up as Stephen Fiorillo? The hair looks like I am. Actually, you know what? I'm not going to bash the dude's hair. The guy's got good style. He definitely does. Mr. Steelio net income. 100%. He'll come back whenever we hear bad news. But I think another main takeaway as well is that SoFi analysts are also still not happy, because this is one thing that I hate about banks, okay? That I do ignore a lot, and it's a problem of my own, is that it doesn't matter how big the overall member base is and how many products and all of these things, okay? If, for example, we have a large amount of balance sheet risk, that problem doesn't change. So it doesn't matter. If you are, I'm just going to pick a number. If you're 90% exposed, okay, which isn't true to be fair, but regardless if you're a $400 billion company or a $4 billion company, your risk of bankruptcy is still quite large if you still have the same similar amount of default rates on the total amount of products that you hold on your balance sheet. That is a big problem with banks. The good thing about SoFi and the good thing about the large banks is that they're able to diversify. So if you look at JP Morgan, they have mortgages, they've got auto loans, they've got personal loans, they've got they're dipping their toes with corporate lending and IPOs. They do every single thing, advising and consulting, and they just diversify like crazy. So whenever there is one thing that's down, that's fine. Let's lean over here. And then whenever, so it's a big game of juggling, right? So SoFi needs to diversify more. Luckily, we're just starting to do that with our overall lending platform, where we're starting to get mortgages up, student loans, personal loans, first time in over 2 years, okay? Another thing, now we have contribution profits in our actual financial services, which they said going forward will also be profitable. So we're out of that era of having a negative on our stock from financial services, and it should only grow as a percentage from here, okay? So as the older cohorts for the SoFi Invest platform, which supposedly are still bringing in large negatives, a lot of those large negatives are actually from the new users that we're still bringing on, okay? The older you are as a member, if you're a Robinhood investor like TJ, like Amit, like all these people who have been using their platform for years, they are not down on you guys. Okay, especially TJ. They've made their money. Okay, but if you continue to buy more and more shares slowly, that brings up the average revenue per user. You only paid for it once, right? You only paid for the customer acquisition once. And yes, there are servicing costs, but those are minimal. What do you think about earnings results tomorrow? Why don't you go watch the video, my friend? Because that's what we were talking about. That was the whole day. We were talking about SoFi and PayPal. I can't wait for tomorrow. It's going to be a lot of fun. Oh, and I want to mention, don't go anywhere. Tomorrow we got a whole panel of investors that are going to be talking. Well, I think they'll be flowing in and out. There'll be some people that'll be able to pop in later. Anyway, it'll be cool seeing some new faces on this show tomorrow. Very, very cool. That'll be for PayPal's earnings results. It'll probably be a long one. I hope that we get to hear a lot from Alex Chris and that he's just as transparent and fun as Dan Schulman. All right. One more quick snap of the fit. And we're off. Thank you all very much for joining me. It's been a fun one, but we're out of here. I'm gonna go watch a scary movie with my wife. She's still my girlfriend, but maybe. Bye.